potentially build this portfolio? I hear your logic and it makes sense, but at what point would it just be too much?
Well, first of all, we already have taken a lot of this into consideration. I mean, if you look at our positioning, we brought back the beta in our portfolios this year. We're focusing pretty much on large cap equities and mid cap equities, less inclined to be in the higher beta sections like small cap equities, emerging market equities. So we've already taken into account a lot of this volatility. Now, what would make me more nervous about the markets is really looking at what these tariffs actually mean going sector by sector. And we let's go through each and every sector. And sometimes I think you got to remember that the economy isn't necessarily the equity market. And I'll just give you a quick point. If you look at auto-related tariffs, keep in mind that auto-related stocks in the S&P 500 account for 2.1% of the market cap and only 1.4% of the earnings. So it's not as big as what people think. And by the way, one company, Tesla, represents 1.6% and that's approximately 2%, allocation. So I think you have to dig down and look at what is actually going to be the impact on each respective industry and sector. And that's really what we have to continue to do as these tariffs are announced.
To the extent that the economy does matter a bit here to certain sectors, consumer, for example, where a lot of investors are worried that the consumer might drag things down a bit here. They're afraid of inflation. They're afraid of the cost of their car eventually going up on the heels of these tariffs. Where does that make a difference? You have different strategists, say Goldman Sachs, ratcheting up their recession odds here. Does that make a dent?
Well, if we were going into a recession, clearly that would be a big negative for this market. But right now, I will agree that when you look at some of the soft data, sentiment indicators, you are seeing some softness. However, I will tell you that has not necessarily been the best indicator of where the economy is going. And I'll just point out to one particular factor. If you look at the consumer confidence expectations component, historically, you'll hear economists say that when that falls below 80, that's recessionary. And it is true, the last 4 recessions, it was around 80. However, it's reached that level over the last 30 years 15 times. So it's not necessarily a guarantee when it gets to that level that you see a recession. We tend to focus more on what we call high-frequency data points, and I still think the consumer's in pretty good shape. When I look at withholding taxes, they're up 8% year over year. What does that tell me? It tells me that there's either more people working or they have more money to spend. But the bigger story is that the biggest part of the U.S. economy, the consumer, has more money to spend. When you look at jobless claims, that's high frequency. And that continues to be at historically low levels. And then when we look at our activity metrics, when you look at TSA, that's pretty much flat versus where it was last year, but it's had a big bounce back since January and February. People are still going out to eat. They're still going to hotels. Right. When you look at credit card momentum, that continues to move higher. So I'm not seeing the weakness that a lot of people are talking about with this consumer getting to a recessionary conditions.
Yeah, safe to say, Larry, you're taking the other side of a lot of the doom and gloom that we've been hearing on this program and elsewhere on Bloomberg. But I want to talk about how you're thinking about bonds right now. Bonds obviously caught a big bid in the first quarter. According to a Bloomberg story, through Friday, Treasuries have outperformed stocks this quarter. We haven't seen bonds rise and stocks fall in a 3-month period since 2020, which certainly tells you something. You're not calling for a recession here, but where do bonds fit into your portfolio?
I actually like bonds. In fact, we call them, you've heard of Mr. Irrelevant. We think bonds are very relevant now for portfolios. And the reason for that is that bonds are doing what bonds do best. They're providing income. And if you look at corporate yields right now, they're at the highest level that we've seen in a decade. So you are getting income from your bond portfolio. And to your point, they are serving as a ballast to the equity volatility that we're seeing in the market. And that's historically been the case. And I think that's going to continue going forward. Now, the big risk out there that everyone wants to talk about is that once the debt ceiling gets accomplished, you're going to see huge issuance. And that's going to take yields higher to 6 or 7%. We are not in that camp. And the reason for that is that we still think demand remains healthy for bonds. And the main thing that we look at is something called the bid to cover ratio. And it continues to be at 2.5. So there's 2.5 times more demand for every bond auction that comes out. And the good news is that trend continues to move higher, not lower. So that's a sign of increasing, not waning appetite for bonds.
Larry, we thank you for joining us today. Refreshing to hear a contrarian view in a market full of bears today. That is Raymond James, Chief Investment Officer, Larry stocks moving this hour. We're going to bring in Bloomberg's Nora Melinda for that because, of course, let's start with these vaccine stocks.
Lots going on in the market today. I'm keeping an eye on vaccine makers, including Moderna. It's down more than 10% this morning. This is after Peter Marks, who has been a top regulator at the FDA. He abruptly resigned on Friday, and he's been one of the strongest advocates of vaccines and gene therapies. And in his resignation letter, he cited friction with RFK Jr., saying that and we know RFK Jr. is a longtime vaccine critic, and of course, the current Health and Human Services Secretary. He's saying that truth and transparency are not desired by the secretary, and so we're seeing a lot of those vaccine makers tumbling on the news, Moderna and Vaxcyte as well. But in another space, when we look at M&A, I'm keeping an eye on Rocket Companies. It's an online mortgage provider, and it's buying Mr. Cooper. That is a mortgage finance company. We've got shares of Mr. Cooper up about 19%, but if you look at Rocket shares, they're down about 10%. And they did have an all-stock transaction. This was a $9.4 billion deal, pretty straightforward transaction. And we know that Rocket earlier this month said that it would buy Redfin. So lots of deals going on here as we think about the housing market. But lastly, I'm also keeping an eye on CoreWeave. We know that this name has been very topical, but we had analysts who are disappointed by the heavily downsized IPO that we've all been discussing here on Wall Street. They raised about $1.5 billion. The company opened at $39 on Friday, which was about 2.5% below the $40 per share IPO price, and which is really waning enthusiasm as we think about AI stocks. So lots going on here.
Yeah, it's a really tough market for a tech IPO, so we'll continue to watch that one. A really important bellwether. That is Bloomberg's Nora Melinda with your latest stocks roundup. As we watch the S&P 500 hit session lows, we briefly touched a 2025 low, so keep an eye on these benchmarks. Could see some wild trading at quarter end. Now, coming up, we'll have more on that shakeup at the FDA. That conversation up next. This is Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused.
Alright, we're currently shorting down to Outlier. We're currently looking for those 55.25. We'll see if we can get down to those lows. See what we can do down there. See if we can take us down there. We also have Bloomberg in the bag. It's big news this week, so nice to stay informed of what is going on.
Great companies in the US. It's hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative. If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
The latest in tech and AI news, whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
David Weston, joining you for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wingstop getting upgraded to a buy over at Jefferies. The firm says that shares of the chicken wing chain are oversold. Next up, we have Barclays cutting Canada Goose to a sell, citing increasing competition and tariff headwind. Shares down another 6.5% right now. And finally, U.S. Steel getting downgraded over at BMO Capital Markets. The analyst cites uncertainty over the Nippon Steel transaction. I've certainly heard that one before. Meanwhile, we're also keeping an eye on the vaccine makers slumping in the early trade. That's after news this morning that the head of the FDA's vaccines unit, Peter Marks, has resigned. Marks cited friction with Secretary Kennedy, who he was willing to work with. However, he wrote in his letter, it has become clear that truth and transparency are not desired by the Secretary, but rather he wishes subservient confirmation of his misinformation and lies. Let's unpack that news with Bloomberg's Rachel Kors Zhang, who joins us now. And Rachel, some really harsh words for the new HHS secretary.
Indeed. Peter Marks and HHS Secretary Robert F. Kennedy Jr., they know each other. They have a history. They had met about Kennedy's views on vaccine usage during the first Trump administration. And I think it's become clear that, his views and the views of Peter Marks, who is kind of the top regulator of vaccines and gene therapies at the FDA, were ultimately incompatible.
Rachel, what is the read-through for the vaccine makers? You're seeing, of course, the markets start to react quite strongly. Should they be?
I think there's significant uncertainty, and uncertainty is bad for business. In drug development, it takes several years for these drugs to go through the studies that they need to. VC investors are nervous when there's uncertainty about who's going to be ultimately making the decision at the top. And Marks was certainly an advocate of approving innovative medications for disease areas where there were no other therapies available. And that earned him criticism from some people who thought he was too friendly to industry and too willing to take risks before drugs were really proven. So I think industry certainly worked well with Peter Marks, and I think they're just uncertain as to who.
I'm gonna close there on every account.
That is Rachel Kors Zhang. Now we're going to switch gears because America's largest loan servicer is being bought by the nation's largest lender.
1,300 and 1,200 on every account. Oh my goodness. Oh my goodness. I'll see you guys tomorrow. Holy. Oh my.